What if the economic fate of the United States was not entirely in its own hands? Imagine for a moment a world where the currency in your pocket, the dollar, is significantly influenced by decisions made thousands of miles away. A world where the economic might of the United States is linked to the financial strategies of a different superpower. Intriguing? Well, that's precisely the world we live in today. Let's delve into the world of foreign reserves and explore the giant across the Pacific, China. Scene script. China, the second largest economy in the world, holds a significant amount of foreign reserves. But what exactly do we mean when we say foreign reserves? Foreign reserves are assets held by a country's central bank in different currencies, gold, or other forms of safe investments. These reserves serve as a safety net, providing a cushion against economic shocks, stabilizing currencies, and enabling countries to pay for their foreign debts. They are, in essence, a country's financial safety net, giving it the ability to weather economic storms. So why has China amassed such an enormous amount of these reserves? The answer lies in their shift from a closed economy to an open one. A closed economy is one that doesn't trade with other nations, while an open economy readily trades goods, services, and capital with other countries. China's transition from the former to the latter has brought about an unprecedented accumulation of foreign reserves. As China opened its doors to the global market, it saw a massive influx of foreign investment. These investments, combined with China's robust export machine, led to a surplus of foreign currencies, primarily the US dollar. This surplus is what's known as a trade surplus, which is when a country exports more than it imports. This surplus is then added to China's foreign reserves, leading to their growth. But China didn't just sit on these reserves. Instead, it has strategically used them to further bolster its economic standing. It has invested these reserves in foreign markets, bought assets around the globe, and loaned money to other countries, all while keeping a tight grip on the value of the yuan. These strategies have turned China into a global economic powerhouse, one with a massive war chest of foreign reserves. But these reserves are not just a symbol of China's economic prowess. They are also a tool that China can and does use to influence global economics. These reserves, largely dominated by the US dollar, have significant implications for the USA. And as we journey further into this topic, we'll explore just what those implications are. The growth of China's foreign reserves has not been a steady rise. It's a story of strategic decisions and global economic shifts. China's journey into becoming a global economic powerhouse started with its entry into the World Trade Organization in 2001. This pivotal moment opened the floodgates of global trade for China, allowing it to start amassing a significant foreign reserve. As the world's factory, China's exports outpaced its imports, leading to a trade surplus. This surplus, primarily in US dollars, was the catalyst for the growth of China's foreign reserves. By 2006, China's foreign reserves had ballooned to over $1 trillion, a growth largely fueled by its burgeoning trade with the rest of the world. Fast forward to 2008, and we face a global financial crisis. While many nations struggled, China's foreign reserves continued to grow. The crisis led to a reduced demand for Chinese goods, but China's strategic decisions to invest heavily in US Treasury bonds ensured that its foreign reserves didn't take a significant hit. In the years following the financial crisis, China continued to diversify its foreign reserves, investing in different currencies and assets. By the end of 2014, China's foreign reserves had peaked at nearly $4 trillion. However, the story didn't end there. In the years that followed, China faced economic slowdowns and market volatility, leading to a decrease in its foreign reserves. Yet, even with these challenges, China's foreign reserves remain one of the largest in the world, testament to its strategic economic decisions and resilience in the face of global economic shifts. Now, why does this matter? Why should we care about the growth of China's foreign reserves? Well, it's simple. With each decision and global event, the implications for the USA grew wider and deeper. The story of China's foreign reserves isn't just a tale of numbers and economic policy, it's a story of power, influence, and the shifting dynamics of the global economy, and that, my friends, is a story worth telling. So, how does this stack of foreign reserves in China affect the United States? Imagine that the global economy is a huge, interconnected web. Each thread represents a trade route, a currency exchange, a debt owed, or a loan given. In this web, the United States and China are two of the largest, most powerful spiders. Now imagine that one of these spiders, China, has accumulated a vast reserve of the other's currency, the US dollar. This isn't just an interesting fact, it has real tangible impacts on the United States. First, let's talk about the value of the dollar. China's massive reserves of US dollars give it significant influence over the dollar's value. The more dollars China holds, the more it can affect the dollar's value on the global market. If China decides to sell a large portion of its reserves, it could potentially drive down the value of the dollar. Conversely, if China buys more dollars, it could drive the dollar's value up. Next, there's the matter of interest rates. When China buys US Treasury bonds, which it often does as a way of investing its foreign reserves, it's essentially loaning money to the US government. The more bonds China buys, the more it helps to keep US interest rates low. This is because when demand for bonds increases, their yields, which move inversely to their price decrease. Lower yields mean lower interest rates, which can stimulate economic growth by making it cheaper for businesses and consumers to borrow money. However, this relationship also has a downside. It means that the United States is heavily indebted to China. As of early 2024, China holds over $1 trillion in US debt, making it one of the largest foreign creditors to the United States. This debt gives China leverage over the US, as it could potentially cause economic disruption if it chose to sell off a large portion of its holdings. Finally, there's the effect on trade balances. China's foreign reserves are largely a result of its trade surplus with the United States. In other words, China exports more to the US than it imports. This trade imbalance can have several effects, including contributing to job losses in certain sectors of the US economy. The complex relationship between China's foreign reserves and the US economy embodies the intricate dance of global finance. It's a dance of give and take, of power and dependence, of risk and reward, and at its heart is a dance of dollars and yuans. The intertwined fate of these two economic giants is a dance of dollars and yuans. So we've traveled through time and across the Pacific to understand the impact of China's foreign reserves on the USA. Let's take a moment to recap our journey. We began by setting the stage with a look at China's foreign reserves. We learned that these reserves are made up of various foreign currencies, but the majority is in US dollars. China's reserves have grown exponentially over the years, transforming it into the world's largest holder of foreign reserves. This growth didn't just happen overnight, it was a calculated move, part of China's economic strategy to maintain a competitive edge in exports and to safeguard its economy against currency fluctuations. We then delved into the timeline, tracing the growth of China's foreign reserves. We saw how China's economic reforms in the late 20th century led to an influx of foreign capital. With its low-cost labor and favorable policies, China became the world's factory, attracting businesses from around the globe. As a result, China's foreign reserves ballooned, with a substantial portion in US dollars. From there, we moved on to the heart of the matter, the impact of China's foreign reserves on the USA. This is where things get particularly interesting. You see, China's large holdings of US dollars give it significant leverage over the American economy. By buying US Treasury bonds, China helps keep US interest rates low. This in turn stimulates the American economy by making it cheaper for businesses and consumers to borrow money. However, this relationship isn't without its drawbacks. The USA's dependence on Chinese investments to fund its budget deficit puts it in a vulnerable position. Should China decide to sell off its US holdings, it could trigger a rise in US interest rates, potentially leading to an economic slowdown. But it's not all doom and gloom. This interdependence creates a delicate balance, a sort of economic dance, if you will. It's in neither party's best interest to disrupt this balance. For China, a strong US economy means robust demand for its exports. For the USA, Chinese investments help keep its economy humming along. So what's the takeaway from all this? It's the realization that in today's globalized world, the economic destinies of nations are intertwined. Even as we speak, the dance of dollars and yuans continues, shaping the global economic landscape. As we navigate an increasingly interconnected world, the dance of dollars and yuans continues, shaping the global economic landscape.